Okay, let's unpack this. We are doing a deep dive today into a market that isn't just growing, it's really transforming. The specialty coffee shop market in India.
It's an absolute explosion.
Right. And for you listening, we've got a comprehensive market report, and we're layering a real-world business plan right on top of it. The mission here is to cut through the hype and get to the hard numbers.
Find out who is actually spending the money, where the growth is, and what it really takes to be profitable on the ground.
And when we say explosive growth, that's not an exaggeration. The Indian coffee shop market, and we're just talking the cafe segment here, hit about $380 million in 2024.
And the projection is for it to more than double. We're looking at over $1 billion by 2033. That's an 11.5% compound annual growth rate. It's blistering.
So what does that look like in terms of actual shops?
Well, that's where you see the cultural shift. Right now, there are about 5,300 branded coffee shops, a projection over 10,000 by 2030. This isn't just an economic trend, it's a very visible change in lifestyle.
To really get a sense of the scale, or maybe the potential scale, let's zoom out. The entire global coffee industry was over $500 billion in 2023.
$500 billion. And a giant like Starbucks alone brings in over $30 billion a year.
So when you put India's market next to that...
It's a huge disparity. And that's the opportunity, right? India has the world's largest population, but accounts for only about 0.5% of global coffee shop revenue.
So the market is it's incredibly underdeveloped for its size.
Exactly. It feels a lot like the trajectory we saw in China or Southeast Asia, where once incomes hit a certain point, consumption just takes off.
And just to be clear for everyone, we're focused specifically on the cafe segment, not the instant coffee people drink at home.
Right. The overall industry has a few parts. Home use, ready-to-drink bottles, and then this cafe segment. And while it's the smallest by revenue right now, it's growing the fastest. The number of outlets grew almost 13% just last year. That tells you where the smart money is going.
Okay, so we know the market is booming. But who is driving this? I mean, who are these people choosing a 300 rupee latte when chai is everywhere and so much cheaper?
It really comes down to demographics. Over 65% of India's population is under 35. That's your millennials and Gen Z. And for them, a coffee shop isn't just a place to get a drink.
It's a social destination.
It's a social destination, and maybe more importantly, it's a status indicator. It signals you're part of a modern, globalized culture.
And they can afford it now. With urbanization and rising incomes, spending, 200 to 500 rupees on a visit is becoming an affordable luxury.
And there's a huge utility factor, too. Don't underestimate that. These places have become informal offices.
The third place.
The third place, exactly. With good Wi-Fi and comfortable seating, people are staying for 2, 3, even 4 hours. Remote workers, students, people taking meetings. It's essential infrastructure now.
The report breaks down the customer base into a few core groups. First up are the young urban professionals.
The high-value customers, ages 25 to 40, visiting multiple times a week. They care about the quality of the beans, the ambiance.
And the good Wi-Fi.
And the good Wi-Fi, definitely. Then you have the students, 18 to 25. They're a huge chunk of the traffic, maybe 30 or 40%.
But lower spend per visit. They're the ones using the space for hours to study.
Exactly. So managing that turnover is key. And finally, the remote workers. They provide stable, predictable daily traffic, even if they only buy 1 or 2 things over a long stay.
So it's a balancing act.
It is. Now, shifting to the economics, if you want to enter this market, you have to understand the competition and location. Location is everything.
So what does that landscape look like?
You've got your legacy chains like Café Coffee Day. They still have the biggest footprint, maybe 1,600 outlets, targeting that middle-income customer.
And on the other end, you've got Starbucks India with about 300 premium shops, mostly in the big metros, charging a big premium.
Right. But the real action, the report says, is in 2 other areas. First, the quick service formats. They're expanding like crazy in Tier 2 cities, focusing on speed and price.
And the second?
High-end independence in the metros. They're all about differentiation. Single origin beans, fancy brewing methods, unique vibe, higher margins, but much lower volume.
So where's the sweet spot? Where's the big opportunity?
The sources are really clear on this. While the big metros like Delhi and Mumbai have over 60% of the shops, they're getting saturated. The real frontier is in the Tier 2 cities.
Places like Pune, Jaipur, Lucknow.
Exactly. The report literally quotes someone saying, Tier 2 cities represent the true growth frontier.
It makes sense on paper. Less competition, lower rent, a fresh customer base. But
Huh?
are there risks? Like, can you get good beans and trained baristas in those cities?
That is the challenge, no question. The operations are harder, logistics are tougher, training is more difficult. But the economics are just so much better. You trade a bit of operational friction for a massive reduction in your fixed costs. It's the only path to real scale.
Let's talk about those costs. The unit economics are tight.
Very tight. You're looking at maybe up to 25 lakhs for a premium setup. And operating margins can be anywhere from, say, 4% to 15%. But here's the secret.
The contribution margin.
Your contribution margin is fantastic. Your variable costs, the coffee, milk, cups, are only about 34% of your revenue.
So for every dollar you bring in, 66 cents are left over to cover your fixed costs. That's incredibly healthy.
It is. But those fixed costs can sink you. Rent in a prime spot can be 1 or 2 lakh rupees a month. Staff salaries, another 2 or 3 lakh. That's a huge net to crack every single month.
Okay, so to make all this real, let's put these numbers to the test. We're going to dive into a specific business plan for a promoter, a Mr. Rajesh Kumar, who is seeking a bank loan.
And Mr. Kumar is the perfect example. He's not just a dreamer. He has over a decade of experience in hospitality, and he actually managed the Tier 2 city expansion for a major chain.
He brought 3 new stores to profitability in 15 months.
Right. And he's putting in 15 lakhs of his own money. For a lender, that seriously reduces the risk.
So his plan is for a mid-range specialty shop in Koregaon Park, Pune, a classic Tier 2 city with a metro-level customer base of young professionals and students.
And his strategy is all about differentiation. First, he's focusing on specialty single-origin Indian beans sourced directly. That's a quality story right there.
Second, he's investing in properly trained baristas who can do AeroPress, pour over, all the things that signal quality and justify a higher price.
Third, he's leaning into that utility trend we talked about. Comfortable seating, great Wi-Fi, making it a place people want to stay.
And finally, a smart revenue mix. Not just coffee, 50% coffee, 30% food, 20% cold drinks. That diversification is so important for stability.
Absolutely. Now let's get to the real test, the financials. Is this plan actually viable? This is where that 66% contribution margin creates a huge aha moment.
Okay, so let's run the break even. His total fixed costs per month in Pune are projected at 3,020,000 rupees.
Right. And with that 66% contribution margin, you can calculate the revenue he needs to break even. It comes out to about 4,085,000 rupees a month.
And his average sale is targeted at 300 rupees. So if you divide that out,
Go ahead.
that means he needs about 1,600 transactions a month. Divided by 30 days, that's only about 54 customers a day.
54 customers a day to cover every single cost, fixed and variable.
That seems incredibly low for a high-traffic area in a city like Pune. The study says he expects 50 customers a day in his very first month, so he breaks even almost immediately.
Within the first week, basically. That's the power of a high contribution margin. It gives you incredible leverage, and the plan has a big safety margin built in. He's still profitable, even if traffic is 30% lower than expected.
So for the bank, the key metric is the debt service coverage ratio, the DSCR. How does that look?
It looks very, very strong. In year 1, it's 1.47.
Yeah.
That means he has 47% more cash flow than he needs to make his loan payments.
And in year 2?
It jumps to 3.81. That shows the business can scale and pay back its debt very comfortably.
There's another interesting financial detail here. The plan maintains a 5 lakh rupee cash buffer, even though the analysis shows negative working capital needs. That might sound odd to some listeners.
It's a great point. And that negative working capital is actually a very good sign. It just means the business is so efficient, it collects cash from customers before it has to pay its suppliers for the beans and milk.
But you still want that cash buffer.
Oh, absolutely. That buffer is just smart management. It protects you from any unexpected hiccups during that critical first year.
And of course, there's compliance. The plan has all the licenses covered, FSSAI for food safety, the shop establishment license, and the 5% GST on services.
Which is a pretty favorable tax rate for the industry. The regulatory side is mature, which helps good businesses grow.
So when we pull it all together, what does this deep dive teach us? For you, the listener, I think there are 3 main takeaways. First, location is key, and the smart money is moving to Tier 2 cities.
Second, you absolutely must differentiate. It can't just be coffee. It has to be specialty coffee with a great ambiance and the amenities people want, like Wi-Fi. That's how you justify the price.
And third, you have to manage the finances defensively. That high contribution margin is your best friend, but you have to keep fixed costs under control and always maintain a cash buffer.
All of this expansion leads to a final really interesting point from the report. It's this new business model that's emerging. The franchise-invested, brand-operated model.
What does that mean exactly?
It means an investor can just put up the money fund, the build-out, buy the equipment, but the expert brand, the people who know operations and supply chains, actually runs the store day to day.
So it separates the capital from the operational expertise. That could solve the biggest problem with traditional franchising in India, which is often poor execution by inexperienced owners.
Precisely. And that leaves us with a final question for you to think about. If this more professional model takes hold, could the expansion into Tier 2 and maybe even Tier 3 cities happen even faster than these already aggressive projections? And what would that do to the competitive landscape in the next 5 to 10 years?